Hello, financial enthusiasts! Welcome back to our channel where we reveal the secrets to financial success in building a solid foundation for a brighter future. In today's video, we are diving into the exciting world of the stock market, exchanges, IPOs, and futures. Whether you're a beginner or looking to expand your knowledge, this video will provide you with a comprehensive overview of these important aspects of the financial world. So, let's jump right in. Investing in the stock market may appear daunting to a group of young individuals who have minimal savings and a significant student loan debt of $100,000 for a degree they aren't utilizing. However, if approached wisely, it is possible to transform those meager 2 cents into 3 cents or more, which is an improvement from the previous day. Ultimately, isn't that the objective, to increase one's financial standing? Jokes aside, the stock market is frequently seen as a daunting and unpredictable realm where inexperienced investors are easily overwhelmed and experienced ones amass enormous wealth. While there is some truth to these perceptions, comprehending the stock market and achieving financial gains from it is actually much simpler than anticipated. To gain a grasp of the stock market, it is essential to comprehend the concept of a stock itself. A stock, also referred to as a share, is a financial instrument that represents ownership in a company to a certain degree. In simpler terms, if a company like Amazon has 1,000 shares and you purchase 1 share, you would possess a 1/1000th ownership stake in Amazon. In reality, companies like Amazon have millions of shares, but the main point remains the same. When you own a stock, it signifies that you possess a portion of that particular company. Consequently, as the company's value increases, the price of your stock also rises. There are 2 types of stocks, common and preferred. These terms refer to the voting rights granted to shareholders. Common shares carry voting rights, while preferred shares do not. Having voting rights allows shareholders to participate in decisions such as board elections, mergers, and other financial matters. On the other hand, preferred shares earn their name because they receive priority when a company distributes dividends, which are essentially a portion of the company's profits shared with the shareholders. Preferred shares also receive preference in other financial situations. Stocks can become much more intricate than this, but these fundamental concepts are sufficient for basic investors to grasp. You might be curious about why companies choose to sell stocks, and the answer is quite straightforward. They do it to raise capital. Stocks offer a means for companies to raise substantial amounts of operating capital without requiring additional effort or production. In the present stock market, the value of a company is frequently determined by its potential future earnings. Consequently, even relatively small companies have the opportunity to earn millions or even billions if investors believe in their potential for future success. Therefore, when a company decides to sell its shares, it requires a platform to facilitate the process, and that's where the stock market comes in. Companies make their shares available for trading by conducting an initial public offering or IPO on an exchange. This transformative event changes the company's status from privately held to publicly traded. IPOs serve multiple purposes. They allow company founders to sell their ownership stake and realize financial gains, or they provide an opportunity for the company to raise additional funds for various purposes. Once a company's stocks are available for trading on an exchange, the general public can engage in buying and selling them. Typically, stock prices will fluctuate based on public opinion, but more substantial trends and fluctuations are often influenced by the company's earnings and operations. These aspects can be evaluated using metrics such as PE ratios, price-to-earnings ratios, and various other indicators. This is the point where casual investors may become apprehensive and their interest may wane. However, there's no need to fear, as understanding these concepts is not as complex as it may initially seem. Next, it's important to comprehend the mechanics behind the fluctuation of share prices and the reasons behind it. The stock market comprises numerous investors and individual traders, each holding their own unique opinions and sentiments about a particular company. These individuals make independent decisions, and the collective outcome of their choices determines whether a stock moves in a positive or negative direction. When there is an increase in buying activity, more people purchasing shares, the price naturally rises. Conversely, if there is a collective desire to sell off shares and exit a company, the lack of demand leads to a decline in the stock's price. The fluctuation of share prices is influenced by the dynamics of supply and demand within the stock market. Let's consider an example to illustrate this concept. Imagine you post an item for sale on Craigslist at $100 and immediately receive 100 emails from potential buyers willing to pay cash on the spot. At this point, you might start thinking that you priced the item too low and consider raising the price until it reaches the maximum amount the last buyer is willing to pay. Conversely, if you received no offers, you would likely lower the price gradually until someone expresses interest and makes a purchase. This process resembles how the stock market operates, although the price fluctuations are not consciously controlled. In the stock market, the rise and fall of prices occur through millions of transactions taking place every second, driven by the principles of supply and demand. Each stock trade requires both a buyer and a seller. If there are more buyers than sellers, the price tends to rise. Conversely, if there are more sellers than buyers, the price tends to decline. The interplay of supply and demand governs the movements of stock prices in the market. Traders often discuss the bid-ask spread, which refers to the difference between the bid price, or what someone is willing to pay to buy as a share, and the ask price, what someone is willing to sell a share for. Understanding supply and demand is relatively straightforward. If more people desire a particular item, in this case a stock, its price will increase. Initially, stock markets relied on manual processes on a trading floor to match buyers with sellers. However, nowadays, the majority of matching is automated, performed by trading systems. This automation enables the market to operate at a much faster pace, contributing to the rapid and dynamic nature that casual observers often notice when watching the stock market. Now, you might be questioning the value of investing, especially when you can simply earn 2 to 3% by keeping your money in a bank account, which seems safer and less complicated. However, the answer is rather straightforward. Investing has the potential to yield substantial returns. Consider a common example you may have heard before. If you had invested $1,000 in Amazon stock back in 1997, you would have approximately $1.5 million today. Admittedly, this is a long-term investment, but the significant growth potential makes it an attractive option. Other companies often offer annual return rates of 30 to 70%, which can still generate substantial wealth compared to the modest 2 to 3% earned through a bank account. Essentially, as long as you can achieve a higher return than the meager interest rate offered by banks, you are better off investing your money in the stock market. The potential for greater financial gains makes investing a worthwhile endeavor. Now that we have a basic understanding that the stock market is a real-time marketplace where you can buy shares of companies you believe will be successful, let's explore how to get started with investing. The first requirement is to have a trading account. You can open one with well-known providers such as E-Trade or major banking institutions. Alternatively, you can opt for free trading services like Robinhood. Traditional trading services typically charge fees for each trade you execute. However, newer technology-driven companies like Robinhood have revolutionized the industry by offering commission-free trading. This means you can invest your entire amount without worrying about paying fees to the brokerage. Below, we have provided a link to start a Robinhood account where you can receive a free stock if you're interested. Once you have an account with any trading service, the next step is to determine which company's stocks you want to purchase, which can be the challenging part. It's important to note that stocks come in a wide price range from a few cents to several $1,000s. One crucial aspect to understand about stocks is that you can only buy them in whole units. There's no option to purchase a fraction. For instance, if you wish to invest in Amazon, you'll need a minimum of $1,800 based on the current recording to get started. However, there are plenty of lower priced, well-rated companies available for just a few dollars per share. Before making any purchase, it's crucial to conduct thorough research. You should understand how a company generates revenue, evaluate its financial standing, and consider expert opinions on whether you should buy its stock. It's essential to recognize that investing involves assuming some level of risk. Please note that the mention of specific platforms or amounts is based on the context at the time of recording and may not reflect the current circumstances. It is crucial to ensure that you invest only the money you can afford to live without for a certain period or until a particular stock recovers in case it faces challenging circumstances. We hope this video has inspired you to take a closer look at the stock market and explore the vast possibilities it offers. Remember, investing involves risks, and it's important to consult with a financial advisor or do your due diligence before making any investment. Thank you for joining us today. We appreciate your time and engagement. Stay tuned for more exciting content as we continue to explore the fascinating world of finance. See you on the next video.